Babang, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Sunil Mehta, Chief Executive at Indian Bankers Association, joining in. Welcome to the show, Mr. Mehta, and always a pleasure to speak to you and get insights from you. Mr. Mehta, my first question coming to you is, last 12 to 24 months, we've seen really ups and downs across the economy, across sectors. How would you actually describe the journey for the banking system as a whole?
You will appreciate, I think India is one of the few geographies where this entire situation has been handled much better than rest of the world. For the simple reason, because our regulator as well as our government both have acted proactively. The regulator came out with certain dispensation in the form of providing moratorium during the first phase of lockdown, then with a restructuring option made available, which was extended also, so that those entities which are facing cash flows constraint can withstand that process. Then there were availability of the liquidity. Sufficient liquidity was injected into the market by organizing a special TLTRO windows where the money was injected and smaller, cheaper funds were made available to the banks, especially for creation of the infrastructure development, for funding through the MFSI, for funding through the NBFCs. So all these measures have really made liquidity available when everybody was worried that liquidity will be a crunch during the pandemic time. The second thing which I must compliment the government of India is they came out with the guaranteed emergency line of credit. Initially, it was scheme 1 where entities were covered, then it was extended to the scheme 2, so ECGLS 2, then it came 3, it was expanded for the hospitality and aviation sector also, and then in 4 also, then medical equipments and all these sectors. So most of the sectors which were really under pressure during this point of time, they got the support of sustenance during these 2 years because of the availability of the emergency guarantee line of credit, where there is a moratorium of 1 year for the ECLS 1 and then 2 years for the 2 and onward schemes. So all these things have really supported the economy, supported the entire sector, it supported the banking sector also, and that is reflected in the financial results declared by most of the banks. I think you must have witnessed that this is first time that majority of the banks have declared their profits better than the expected profits, and mainly because of the availability of the liquidity in the market. All these institutions could create better margins also for themselves, and could because of the enablement provided by the RBI as well as the ECLS, the slippages were also controlled to a great extent. So having said so, now there are challenges.
Correct. So absolutely, very correct in terms of what you mentioned, Mr. Mehta, that we are seeing improvement. But on the slippages front, yes, they have been under control. However, the accounts that were restructured under the resolution framework that was issued by the RBI for alleviation of COVID-related stress, that's where now you are seeing around 4 to 5% of such accounts that have slipped into the NPA bucket already. Do you think that could start elevating further and that could become a major challenge for us?
Yes, of course, there will be fresh slippages. I do not deny that. That will impact the sector. Ultimately, what I can tell you is these measures have helped to a larger segment of the society, larger segment of the ecosystem, because if the regulator and the government would not have come out with these schemes, there would have been large scale slippages of NPA, large scale, because all the cash flows of all the industries, all the businesses got eroded because of the lockdowns and all that. So I say, if the system has supported 100 and 100 could survive, otherwise all those 100 would have fallen into NPA. Now at least the slippages will be 15%, 20%, not beyond that. So what I mean to say is at least 80 have crossed the line because of the help and the support provided. 15, 20 still may be there who, despite the support, could not have crossed the line because either they lost somebody who's a key person in that management, or they lost their basic connect for that business because a lot of businesses have undergone changes during this period. So a lot of things have changed. So some of the businesses might have faced a bigger challenge, and they might not be able to come back even after these supports. But only thing is the extent of damage has been minimized.
Right. And with that, absolutely, you know, I mean, what we could have seen if this restructuring was not provided would have been a major mayhem already. Now, with this, if you see in terms of the banks as well, the kind of provisioning that they've started to do against their restructured pool, that has started to go up. In fact, I think the IBA has also made a plea to the central bank to extend deadlines for meeting some operational matrix under the Kamath Committee framework. Now, is it that there is some bit of nervousness amongst the lenders in terms of recoverability of some restructured loans? Are we seeing that?
No, I don't think it's a very major challenge. Of course, as very rightly said to you, that had there not been this support in the form of emergency line of credit and the restructuring window and the moratorium, there would have been a very large slippages. That would have really destroyed the entire economic ecosystem. Because of this support, now the damage is minimized. But having said so, it doesn't mean there will not be slippages. It doesn't mean because some sector has already, there will be slippages. And but regarding nervousness, I think the banking sector has done extremely well during the last 4 or 5 years. Why they have done well? Because 2016, after the application of AQR, that is Asset Quality Review, most of the banks have identified their legacy corporate accounts as NPAs, and they have started providing for. And now, if you see the provision coverage ratio of most of the banks, it is in the range of 75-80%. So 80% of the legacy stress asset has already been provided for. If that has been provided for, what does it mean? There will be no overall time requirement for making fresh provisions, because what has already been provided for 100%, you don't have to make fresh provisions from that. So the provisioning outflow, which was happening on account of the legacy NPAs, is now almost over.
Right.
Now, whatsoever provisioning requirement will happen will be open only for the fresh slippages.
Correct.
And fresh slippages after only the restructured book, where they think the stress is still there. And if you see the restructured book, the proportion is still low, and the proportion of NPA out of them will again be low.
Absolutely.
Volume index comes.
Right. In fact, if we see a trend from FY20 onwards itself, the trend in terms of the health, taking the key financial matrix into consideration, has seen a considerable improvement, and the trend for the banking and the financial system as a whole has been on an uptrend. So again, the anticipation is that probably FY23 itself will see further improvement, where we will see the balance sheets of the bank strengthen and see an improvement in terms of credit demand as well. What would your view be on it?
3 factors. First thing, we presume that there will not be any fresh wave of any of the pandemic and everything goes normal. So presuming that, I can say the banking sector is now well capitalized, so they can definitely undertake the growth. Business models have also undergone a lot of changes during this period, and the ecosystem has become adaptive to it, like digitalization as a way forward. Those who are doing maybe retail shopping now mainly doing it online also. Now doorstep deliveries have become a more pronounced way of purchasing for the common man also. So a lot of things in the ecosystem are changing, and people are adopting it fast. The technology is playing a role. Thanks to pandemic, that it has facilitated the digitalization and these journeys in the country. People have started developing the habit of working from home. Maybe even the media, the journalists, most of people, those who are on the streets now, most of the people work from home because of the connectivity availabilities and the new normal for doing the ways of things. So these things definitely will put ourselves on a better footing. Only thing that challenge is, because many of the accounts which were restructured in 2020, by 2022, the moratoriums may be over, they may be start repaying. And some of the accounts which could not cross that line just because of this, out of that, some portion may find a slippage. So I think the bankers are very prudently have started doing excess provisioning in advance, for the simple reason. The old dictum says that make the head till sunshine. So sun is shining for the banking sector right now because they are making good profits. They have a cushions to create provisions, and they're making provisions for it. I think it's a very prudent thing. Even RBI and as IB also, we encourage people, because if you have the strength, make provision so that save for the rainy day, because tomorrow if there are slippages and some new events come, at least we are able to handle, and you never know about the international events that keep happening every day.
Absolutely. And with this, we are expected to see tightening liquidity from here on as well. Yes, when will the RBI change stance? When will they start increasing rates? Obviously, we don't really know of the dates on it. But once the RBI starts tightening liquidity, which will then push up interest rates, how big an impact will that be with regards to treasury gains? And do you think even if that impacts, it would partially offset in the short term as loans get repriced faster than deposits?
No, loans do not get priced faster than the deposits because in our country, it's the other way around. The deposits get priced faster, and the moment there is a say tightening of liquidity and there is a surge in demand for credit, especially from different sectors, then of course there will be some pressure, the interest rate movement on the interest rate movement, and that may impact the treasury incomes of the banks also. Because ultimately the rising interest rate scenario, the treasury incomes will definitely go down from the legacy investments. So to that extent, but what I feel is, since the pricing of loan for new loan products, that is a dynamic thing. That is where the bankers have a free hand; they can reprice it. So legacy loans, they may not be able to reprice fast, but the new loans, that of course they can reprice fast. But that impact is felt after 6 months or 1 year. Because if you reprice something today, the real interest income will come in quarters, next quarters, 2, 3 quarters, 4 quarters, and then only it will come into the balance sheet. Right. So that is going to make the difference. There is a market expectation that RBI is continuing with a supportive stand as long as a government is comfortable in borrowing, the system needs liquidity. But I hope now the visible aspirations of the people is that maybe after one policy or the second, the RBI may change their stand and start tightening liquidity once they find that the economy is back on track. So let's make business as usual. They may allow it, but it is very difficult to predict what RBI is going to take. But our take and expectation is, yes, maybe at least 1 or 2 policies they will continue, and post that they may start tightening the liquidity.
Right. And what would your view be with regards to credit growth? Because, consensus basis, everyone is looking at a double-digit credit growth in terms of FY23. Do you think that is something which is realistically achievable? Or do you think we will be somewhere in that higher single-digit, lower double-digit mark in that 9 to 10% bracket?
No, I think double-digit is possible, simply possible for the simple reason. Even during this pandemic time, maybe somebody can attribute it to the emergency line of credit, somebody can distribute it to the others. Still, the credit growth of the system was with the range of 6 to 7%. And that 6 to 7% creates enough headroom for to make it a double digit in the good year, because now 22, 23 is yet to start. And if presuming that everything goes normal means pandemic do not recur or any major international events do not impact, then of course a double digit is achievable. There are 3 basic reasons for this presumption. One basic reason is changing landscape and aspiration of the Indian consumers. Now, a lot of people are now thinking about using, even my family was talking when we are going to buy an electric car, because everybody thinks that we should be more eco-friendly and think about it. So the electronic vehicle push, which has already been supported by the government, which is being supported by the climate and all that. So that will create a new variety. Those who have got old vehicles, they will think, okay, let's go to the electric vehicle because that will be more eco-friendly. So there will be a shift in the motor vehicle segment, right from personal motor vehicle to the commercial motor vehicle segment. Then in energy, I think our Prime Minister has gone and made an announcement that we want to see a zero emission country for in the next few years. And for that, we will have to start working on it. And one of the important area where we need to work is replacing our coal-based energy to a solar-based or wind-based. So there will be a shift in this very big segment, because the moment this shift happens, a lot of new investment will have to come into the solar energy and into the wind energy and the other sources of non-conventional energy, which is more green in nature. So that will facilitate shift in the existing ecosystem to new one, new capacities will be created, and that will provide an opportunity for the lenders also to lend to these segments.
Right. And overall, another concern, Mr. Mehta, right now that everyone across countries is facing is with regards to where inflation goes. Taking the global inflation concern into consideration and what Fed does, how do you see the impact on the Indian banking system? And with that, how do you see the impact of the geopolitical crisis between Russia and Ukraine to impact our system as a whole?
Iril, one thing is very great about our India. Unlike other economies, we are very little dependent on the external economies. If you see, our total exports do not constitute even 9% of the entire GDP. Means our domestic production and domestic consumption can take the care of most of the requirement, because we have got the largest young population. So even if we are able to produce for our own people, I think we have enough scope to grow. Second important thing is, some of the earlier manufacturing geographies like China was at the predominant level. They were in a large of the area, were providing very cheap goods to the entire world. Now the focus within India, even outside India also, is shifting. They want to go to new geographies, and India stands a very good chance there, because they think that this is a country which is a real democratic country. People can, things are more transparent. They know what is they are buying. They know how to handle about it. So some bias, positive bias towards India has been created during all this period. And it is for we people to take benefit of it, that how we can create our manufacturing capacities, which can be which can increase our exports, and which can cater to the entire ecosystem. So this geopolitical issues, what you said about the Russia and Ukraine, it's premature to say, because right now everything is in air. Everybody is threatening sanctions and beyond. But these days, world is a global village. It's everybody is so much interdependent that just by boycotting one person, you won't be able to survive in the system, because you are dependent also on that person. You say, I'll boycott my mate tomorrow. Who will you clean your house? You say, so that as simple as that. It's not that she's dependent on you for salary. You are also dependent on her for your household work. Absolutely. Same way, Russia is an energy source for the major part of the Europe. Right. And the gas and then oil supplies and all that. And I don't think any country can survive without the energy supply. They need to have some arrangements. So what will happen? Maybe there will be some sanctions. That has happened in the past also. Sanctions were there in the past also. There will be some initial hiccup. Then people will find India is a very well placed and better placed country among all, because we already have a long standing bilateral trade arrangement with Russia. So our impact with that country will be much less. Only thing is, indirect impact will be marginal. It may not be significant for the country as a whole, but direct impact will be very less. And then India has been dealing with Iran, which was having US sanctions. We could find the ways to handle those situations. So Iran was under sanctions, but India has a barter type bilateral trade system with Iran, and then we do supply our food grains to them. We do supply the basic essential items, medicines to them. So I think the world will find its own way, and we are at a better position than the rest of the world, because Absolutely. They don't have any bilateral arrangement, but we have.
Absolutely. So the pretty better placed in terms of global crisis right now. Rightly put out, Mr. Mehta. Thank you so much for joining us on the show. It's always a pleasure to understand from you as to what's happening around the system as a whole and get insights from you. Thank you. Stay safe and speak to you soon again.
Okay. Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.